The changing world order in the stock market. What did the Fed just say? What did BlackRock just say? What is going on in the markets? Why is the Fed tapering its balance sheet and starting to pull money out of the equities market? How is this going to impact you directly? What can you do? What are very intelligent investors, data and statistics saying about these market conditions? In today's video, we are going to be going over a multitude of key information and statistics that you can keep in mind and how this changing world order and the markets are going to impact your lives moving forward. Before we dive into this video, please make sure to smash that thumbs up button. Smashing is very imperative. Make sure to leave a like. Make sure to comment down below your impact on how this is going to impact markets overall in your opinion. And make sure to subscribe to the YouTube channel if you have not done so already. Furthermore, let's dive into this right now. So if you see right here, the Fed reiterates pledges on near zero rates and 120 billion in monthly bond buys. The Federal Reserve is keeping interest rates unchanged near zero, and they will keep, buying bonds at a rate of $120 billion that month. Now you're going, why are we talking about this? This is what the Fed was doing. This is what they were putting into consideration. This is what they were doing recently. They were buying bonds, keeping everybody's 401k, stock markets, and everything like that up and on, a high boosted from pushing this money into the markets. Now recently though, inflation reached its highest level since 1982 as consumer prices jumped 7% alone in 2021. The Fed's biggest ever bond buying binge is drawing to a close. That's why I bring that up. What we just addressed there with them buying the bonds and keeping interest rates low, that is a thing of the past. Market conditions are going to change and we're going to see a different market structure, as they want to say, the new changing world order of the stock market. Central bank's final treasury purchase is scheduled for Wednesday, and pandemic era asset purchases by Fed totaling near $6 trillion as of March 9th, 2022. And again, this is signaling that the Fed Reserve bond buying program is going to come to an end soon. Brenner says Fed to shrink balance sheet rapidly as soon as May. So as we've been seeing the Fed's going to raise interest rates, 25, 50 basis points, 7 to 8 times. I think it could even be more than that. And they're going to start tapering because they know that with CPI and with inflation high, they're going to have to change the way they evaluate and move forward as far as the Fed's balance sheet and interest rates and how that affects CPI and a multitude of other things. Now, with that being said, we can see from Jerome Powell that he's signaling faster pace of rate increases and likely having that bond runoff that we were mentioning. Now, what is the federal funds rate? The target interest rate set by the Fed at which commercial banks borrow and lend their extra reserves to one another overnight. So that is what the federal funds rate is. What is this impacting? How is this going to impact you? Now, if you look at average rates, let's put into perspective a 300K home. On average, that's about, what the typical home is going to be costing you. So if we put that in consideration on a 30-year fixed loan with a 20% down payment, we are looking at about a 6.5%, anywhere between the credit score of 700 to 720. So that is a substantial increase in a 30-year fixed loan compared to what it used to be when rates were at 0%. So with that being said, this is going to affect real estate in a multitude of ways, and it's really going to affect that first and foremost out of anything else. The next thing, the case for big Fed rate hikes just got a little stronger. We've been seeing recently, the Fed's been saying we really need to get this inflation under control. And how are they going to do that? They're going to do that with raising rates. Someone cited, I do not envy the Fed for what it must do next. The stronger the recovery, the higher the rates that follow. I believe that this could be significantly higher than what we previously planned. So again, number one, what is the Fed's problem overall? We address that they're going to end bond buying, which is going to affect, everybody's 401ks in the equity markets as they're stopping. They're going to put a halt on buying in the process for those bonds. They're going to reduce their balance sheet overall. They're going to raise Fed funds rate, which is going to affect, what they're charging banks and stuff like that, and houses and other things, etc., that we've mentioned, and they're raising hike increases. So not only are we going to see, a multitude of 25 basis points or 0.25% raising on hikes. We're going to see, maybe a 50% raise also. So get ready for a new world order that drives stocks and bonds BlackRock states. Stocks, bonds, and especially value tend to do well 3 years after a rate hike cycle starts. Now, why is BlackRock saying this? We have seen over time and time again, we have seen these high growth stocks, these tech stocks really outperform value stocks. But when rates start to increase and people are spending their money differently with the hikes, we start to see value stocks start to perform better than tech and high growth and high risk stocks. So that's something to keep in mind. BlackRock also states, telling investors to prepare for the end of backdrop of low rates and slow growth that defines markets since the 2008 global financial crisis. Undoubtedly entail higher inflation and rates than we knew from 2008 to 2020. But a trickier environment for investors, particularly as Russia's war in Ukraine threatens to keep energy and commodity costs in focus. So again, they're calling this equity groups not only a new world order taking shape that will undoubtedly enter higher inflation. So there's going to be more higher inflation ahead and more higher rates that we knew from 2008 to 2020. This is coming from BlackRock, a very well-known institution that has a lot of liquidity and a well-branded reputation. So keep that in mind. So if you look at this chart right here, this is comparing growth stock versus value stock performance. So we can see growth stocks are continuing to do, very well recently, as value stocks have kind of been lagging behind. Now, with that in mind, you also need to keep in consideration some of these tech stocks are down 75% from their highs last year. These are among the biggest losers. In high growth tech stocks, we're already getting plummeted before Russia's invasion of Ukraine, and this has only continued to get worse as people are moving towards more value, as we've shown that value has continued to do better in high rate cycles than growth stocks. If you look right here, taking hikes in stride. This is the performance in periods after the first Fed rate hike, and as you can see, the 1 year, 2 year, and 3 year, on that third year, you can see that value really starts to outperform and do better compared to value stocks. Value stocks will continue to rally in 2021, they said on December 9th of 2020, but overall S&P 500 returns will go down, says B of A. So that's something important to keep in mind. So they actually already called for this, that value stocks will continue to do better, but overall, the high growth stocks and stuff in that metric and area will not do as well. The relative discount for value stocks remains nearly 2 standard deviations below average. So that's also something to keep in mind. On average, these rotations lasted for 4 months and resulted in a 15% outperformance for cyclical stocks. The firm highlighted that since the great financial crisis in 2008, there have been 15 rotations in cyclicals and out of defensive stocks. So that is the market's new order. That's what's happening. Now, some analysts and strategists are saying a bear market rally is setting stage for a correction, says Morgan Stanley's Mike Wilson, which he warns on April 4th of 2022. So that's also something to keep in mind. Despite the latest market bounce, Morgan Stanley's Mike Wilson is bracing for an S&P 500 decline of at least 13% between now and September, he states. Low rates, said Tuesday, the central bank needs to act quickly and aggressively to drive down inflation, which we've mentioned. And not only that, but some other information is the U.S. economy will fall into a recession this summer as inflation eats into consumer spending, formal Fed officials are warning. As the Fed is nowhere close to controlling inflation, says Lindsay. These are a multitude of information of what people are saying, what is going on in the markets, and what analysts are really, expecting to happen moving forward. With this changing new world order, we're starting to move away from high growth and speculation to more value in these market conditions. Fed must inflict more losses on stock market investors to tame inflation, says former central bank. Feds will have to shock the market if financial conditions don't tighten. So again, this is some more information. Now, what does this say? What does this mean going into it? for the corrections. Based on data going back to 1928, the S&P 500 has seen a median gain of 11.5% a year after exiting correction. An average gain of nearly 14%, rising nearly 77% of the time. Median and average returns for shorter term time frames were also positive. So after we get out of this correction, we can expect a pretty good ROI or return on investment after these corrections, if there is to be one moving forward based on some of this data and analytics. There's a 35% chance that the S&P 500 could fall into a bear market, Bank of America. So we're seeing a lot of these analysts, some of these market effects of the changing new world order that's happening in the equities market and in the stock market. What's your opinion right now? And if you've watched so far, please make sure to smash the thumbs up button and subscribe if you've not already done so. Really appreciate your support and watching through and getting all this information. That way you have the financial education needed to take yourself to that next level and have financial freedom. Surging interest rates push mortgage demand down more than 40% from a year ago today. That's also important to keep in mind. Again, we just showed you that the 30-year fixed rate mortgage rates are continuing to increase as the Fed continues to hike these rates, and it will only continue to increase more. That's not to state that there's not a high demand and a low supply, which is very true in the real estate market right now, but there's no questionable doubt in my mind that with interest rates increasing, the buyer's demand will go down significantly, which could affect the housing market negatively overall. A wave of millennial buyers, although I did state that, are still flooding into the housing market amid record high home prices. So again, there's still that demand from millennials. And as you can see in this chart right here, the S&P 500 returns and rising interest rates environment versus other environments, you can see monthly stock returns are 3 times lower in a rising interest rate environment than when there's not higher interest rates. Increases. So that's something we've been stating also. And you can see right here also distributions of S&P 500 returns and rising rates environment. 10% of the time monthly returns are greater than 5%. And right here, what is really going to outperform, again, based on what we were just saying, underperform when the Fed raises rates are things like, food, beverages, healthcare, but outperform when the Fed inflation rises is banks, energies, financial services. So we can see rises in inflation expectations tend to be more supportive of value sectors. So again, value is going to continue to do better when inflation increases at a substantial rate, compared to growth and value. So that is the changing world order, what it means, how the market conditions are changing over time, kind of a recession warning if it may possibly happen. We've seen a lot of analysts and people that are covering these markets and have a lot of information saying that, maybe a recession may be on the horizon, but when we come out of that, we'll continue to see more growth. Either way, my thing always stays true. I like to buy low and I like to sell high, and I like the dollar cost average into the market because I know time can either be my best asset or worst asset. What is your opinion on this? Make sure you leave it down in the comment section down below. Make sure you check out BrilliantFinance.com and check out our other social medias on TikTok, YouTube, and Instagram. I appreciate you sticking around. I hope you enjoyed this video and found a tremendous amount of value in it. Make sure to subscribe if you've not already done so. Have a good rest of your day. Have a good rest of your weekend. Peace, brothers. Much love.